So let's discuss adjusting scale outs to a changing market environment. Well, one of the things that, part of what prompted the conversation was that Anthony had mentioned that he noticed that a large number of his trades uh, reached and surpassed the 2R level or the his second scale out level, which is great. That's what we would want to see. All right, if we're risking one the ratio that makes the most sense for us is that if we're flipping a coin, we want to get paid $2 if we're right and lose $1 if we're wrong, and we want to try to skew that ratio even more in our favor as much as we possibly can. What he observed was that many of his trades were going past that 2R level. But he wasn't actually locking in those gains. So he was trying to figure out, well, how can I lock in more of those gains better next year? Like, how should I adjust? Should I be taking off less at my first scale out? Because I believe the way that he was doing it was he would take off 5%. Let's say, let's bring up a stock. Let's bring up this one here, right? So it would be, let's say you take off 5% down here, and you don't know what the stock is going to do ahead of time, right? If we did, then you'd probably own an island somewhere. But he would take off a third here, and then another third, or a third of a third at 10%, and then let the remaining part run. And he'd notice that, oh, there's a good chunk that would go to that second scale out and then keep on running. What should I do? So we had a bit of a discussion, and one of the ways to start to figure out or the best answer to how to adjust and how to adjust dynamically is to use this new tool that we have here, this monthly tracker. And the idea is to really dial in to your statistics each month, each quarter, and to understand, well, what's happening. So for each month, what's your average gain? What's your average loss? What's your win percentage? How many trades did you take? What was the biggest gain that you had? The biggest loss? How long did you hold this? The gain and the loss. And also, what's your average high watermark, and what's your biggest high watermark over those periods? And there's some very important reasons why we want to know each of these stats. So our average gain, well, let's start with these over here. Our average gain and average loss. Well, we're actively managing positions, and if you're somebody that's also actively managing positions, meaning that like you're going to be taking off some at one price, some at another price, maybe you're adding a little bit more, like that's active management. So you're never getting the ultimate top, you're never selling at the ultimate bottom. Your price is going to be sandwiched somewhere in the middle. And so that's how you end up with your average gain, and why it's so important to track both an average gain and your high watermark. So in this example, you're looking at 9. If you're taking off a portion at 5%, a portion at 10%, and then price runs 35%. Now it's up about 40%. Price ran 40%, but you didn't get 40% on that trade. You might end up with, say, 15% on that trade. So that's one of the reasons why I would suggest it's important to track both. Now, here's where things start to get a little bit fun, because if you're tracking this data and you start to see that your average gain starts to increase from month to month, and your average high watermark starts to increase from month to month, then that's something that could signal to you that, hey, I should be allowing my winners to run a little bit more. So maybe instead of taking off a third at my first scale out of 5%, maybe I should be taking off 10% at my first scale out of 5%, or maybe I should be taking off 0 at my first scale out and waiting for what's typically my second scale out. Maybe I should just wait until 10% to take off. I mean, that's where starting to understand what's your average gain, what's your average loss, and what's your average high watermark. Where should I be taking the gains? Because if you're, let's say, instead of your average high watermark, let's say that your average high watermark is 15%, right? So and the most of your trades aren't getting there. Let's say 10% of your trades are getting to your high watermark of 16% over the last month. Then what you would want to do is you would want to be taking off your gains quicker, because you're seeing that the majority of your gains aren't getting to a high level. You're seeing that most of your gains are starting to be smaller. You'd want to be taking your gains quicker. So let's say most of your trades are getting to 5% and then falling back in. That was an observation that Santo had made on a few of the trades. In that case, you actually would have been better off taking off gains quicker in that scenario. So if the majority of trades are only producing 5% and then they fall and they either stop you at a break even or they turn back into a loss, then you're better off taking the 5% gains and start accumulating those base hits, while at the same time tracking your stats. Because if you're just doing the same thing in perpetuity, so let's say you're taking off 5% for January, February, March, all the way through the end of the year, and you're not paying attention to how far are these trades actually going, then the market could start to take off, and you're still taking these tiny gains where you could have allowed your gains to run. Paying attention to your stats closer in this way is what will help you see in real time if you should be giving the trades a little bit more room or starting to tighten up. And it'll help you capture more of the bulk of the move. So that's the purpose of, or at least, well, one of the utilities, I would say, of understanding what your average gain, what your average loss, and understanding all, having an awareness of what these stats are. The goal that I have with each trade, I've mentioned it before, but I think that it's worth mentioning again. I view trades in three uh, three segments. Uh, Very similar to chess. If you've played chess, you'll know what I'm talking about. There's three parts of a trade. Uh, there's the open, the middle, and then the end. In the open, our objective is to get risk off the table ASAP, without choking off the trade. So that's helping our risk side of the equation, right? Uh, so if we just have this, right, the risk side, the reward side, our objective in the open is to reduce this part as quickly as possible to get it to where there's all the risk is off the table. This part, this red part down here, that's the part, that's our cost of entry, right? Every time that we take on a trade, think of it like there's a cost of entry. This red part down here, that's our cost. We want that to be gone as quickly as possible without choking off the trade. So it's important to have rules that govern how and when we take this off, but to do it in an expeditious way. The quickest way that I've found to do it for my style is that for it to, for my stops to be raised when these three things occur. Write this down. For it to be when, to raise a stop below the 10-day exponential moving average, below a whole number, and below a daily price low. Each one of those three things has to exist. If it's not all of them, then it needs to stay put. In almost all cases, in 96% of cases, that worked and helped me cut losses faster. And that's something that I observed towards I believe I did that. I found that out in August, September of last year, when I ran that test and came up with that rule. That rule alone, if I had applied it universally to all trades in 22, would have saved me an additional 20R. So raising stops quicker and getting our risk off the table is one way to start to skew this reward to risk even more in our favor. Put money back in your pocket. And even here, just look at this number right here, right? Well, where my mouse is. Well, when we start to take risk off the table, that reward number goes way up. So keep that in mind. Get risk off the table as soon as possible. That's what you're doing at the open. When you move into the middle part of the game, now your objective is different. Now you've gotten your risk off the table. Now you want to get to your average gain, whatever your average gain is. The way that you're going to know what your average gain is isn't just by thinking about your average gain over the past year or, well, what it's been since you started trading. No, think about it in, well, what has my average gain been over the past month? Right? If you start to see, well, my average gain over the past month has been 5%, that's the market telling you about your system and your system's performance in the current market environment. Executing well, right? A little bit of a detour here. Executing well is important. Executing your system flawlessly is important. That means not taking random trades, not trading by the seat of your pants, not saying that, oh, well, in this instance, I'm going to do X. No, like executing your system per your rules produced this average gain. Great. Now you have something that says that, okay, by following the rules of my system, my average gain is, say, 5%. So I should start taking off the majority of my gains at 5%. So let's say that's the case over here. I'm going to sell half at my average gain. So 5%. That's the mid. That's what I consider the mid game. Right? Once I get to my average gain. So great. Sell off half at my average gain, 5%. Actually, if it's 5%, that would be down here, but now here, that's so small. Let's just say 10%, so that way visually on the screen it looks a little bit better here. So 10%, right? So I'm taking off half my position at 10%. And now we're transitioning into the end game. What's the end game? The end game is we want to achieve our high watermark, right? Because now we've got a trade that reached our average gain and is continuing to trend, right? The trend is our friend, and we want to allow that trend to go for as far as it's going to go. So we want to achieve our high watermark, and we want to extend our high watermark, right? Think of it like a high tide coming in. Well, we want to see like how far that the high tide is going to go. We want to see it get to a new high level. So how do we do that? And how do we do that without the tide going back out to sea, right? Because what can happen too is that, let's say you get to you got your average gain, right? Now you're at your high watermark, and then it just comes right back in. You don't want this to happen. That's no good. What we want to do is do this part in stages as well. So let's say you get your average gain. Now you're at your high watermark. Let's say that your high watermark is at 20%. Right? Now you're at your high watermark. What do you do? The first thing that I'm going to do is to sell half of what I have remaining. So if I took off half here at my average gain, I would want to take off half at my average high watermark, whatever that happens to be. And how do I know what it happens to be? I'm actively tracking it in here. Great. So now I'm selling off half, and now I've achieved my my high watermark. Now the objective for that last piece is to just let it go for as long as it possibly can, and to sell that last part based on sell rules. So it would either be some kind of a major offensive sell signal, like a parabolic move, or most likely what would happen is that it's breaking some kind of a defensive sell rule, where for me, I'm tracking danger signals. I think everybody in this room here is familiar with the danger signals. For everybody watching this later on, if you're not familiar with the danger signals, there's a tab over here. You could click that tab in the playbook and see all the danger signals that I'm looking for. If I start to see too many danger signals, then that would prompt me to aggressively raise my stop and then end up exiting the trade. But the idea for the end game is to achieve the high watermark and then extend the high watermark. And the only way that you're going to extend the high watermark is by not taking off everything at the last high watermark, but to taking off some and then allowing the rest to go. Because the whole idea is that we want to continue to progressively allow that high watermark to extend as much as we can. And if the market conditions are continuing to improve, then those high watermarks should continue to get higher and higher. Now, what happens if the tide starts to come in? Right? Well, we're trying to allow these high watermarks to go higher and higher and allow profits to run. But what happens if we start to see that instead of price continuing to get to a new level, let's say that, let's change its color now. Let's say we start to get this, and then it starts to roll over, and then the next trade starts to do this. Well, that's where actively tracking these stats comes into play. Because you'll start to see, my average high watermark in January was 25%. But in February, it's only 15%. What should I do? Well, you should start to, if you do get to your high watermark of 15%, you should be taking off gains there versus waiting for 25%. If your average gain goes from 10% to 7%, then you should start taking off more gains at 7% than waiting for 10. That way you're continuously locking down more and more gains. And that's something else. Anthony, you're coming in right in the middle of the talk about, but that's okay. We spoke a lot in the chat. You could ask all the questions too. But if you see that your average gain is starting to drop and now it's at 7%, then that means that you should start to take off the majority, instead of waiting for 10% to take off half of your profits. If you see that your average gain is now 7%, then you would take off half there. Here's something else to be aware of too. If your risk amount, if you're used to risking, say, 8 or 10% on a trade, then if your average gain is only 7%, then that's something that you're going to need to start factoring in too, because you don't want to start having your reward to risk be skewed where you're laying odds, right? Let's take off some of these annotations here. This is starting to get a little messy over here. Yeah, what you don't want to happen is where you have something like this, where your reward is a lot smaller than what you're risking. You always want your reward to be significantly larger than what you're risking. So if you find that your average gain is 7%, then if you're finding that if you find a trade that's risking 8-9%, that's probably one to avoid, unless if there's some sort of an extreme circumstance. For me, right, and there's rules, and then there's always exceptions. Exceptions do not make the rule. An exception to saying that, my average gain is 7%. There's a trade that's risking 8%. I'm not going to take that one. An exception to that would be I find a trade that's setting up, let's say, in a high type flag, and it scores a 10 on the gauntlet. I'm not going to pass that up. That's one where I would say, okay, I will still take this trade, but I'm doing so knowingly. There's awareness to taking that trade versus just saying, let's just roll the dice, right? Well, we're doing everything at a very conscious, very specific level, and we're actively tracking all of our stats. So, what questions do you have?
I just have one comment about another parameter you may want to consider, and it works best with my particular method of trading, which is long term, but taking into consider volatility. By definition, a bear market is much more volatile. So I just take what my usual pattern is taking having a target of 50% and taking 10% off every time it moves 10%. In a bear market, when I'm shorting, I double it. So I'm taking 20% off every time it moves 10%. So you might want to consider that if you're shorting, or if you have a very volatile stock, you may want to look at the ATR to determine whether it's volatile or not. But if you have a more volatile stock, you might want to take more off every time than you otherwise would. And you might also want to have a smaller position in a more volatile stock, because a more volatile stock can move against you a lot faster.
What measures of volatility are you looking at? So you mentioned the ATR. Are you looking at anything else?
That's really the only one I look at, other than the VIX, just as a general market outlook. But ATR for a specific stock.
Mm. And do you have a certain measure on the ATR? For example, I have an indicator that I turn on just to see if price is falling below uh, 1.5 times a 10-day ATR. And I'll throw that on and see if and count that as a danger signal, right? So if I was in this trade here, um, on this day, that would count as one danger signal. Um, what ATR are you considering, or does it not matter?
Well, the average true range of this particular stock is pretty low. It's 1.18, and I usually try to look for low ATR stocks because they're not going to move as fast. Um, I've said in the past that I try to keep it at around 8, but we'll go maybe 10 or 11 if I really like the stock.
Mhm.
But it's basically a measure of how far it moves on any given day. So it's not going to move more than a couple of dollars in a day. More volatile stock is going to move, like I have a couple in my portfolio that could move $10 a day in either direction. And with a pretty big position, it could add up to a lot of money.
Sounds like we're also talking about the percent daily range. Is that am I right here, Chet?
I guess you could say that. I mean, that's not the indicator I use, but
It might serve
that
the
could
same
be
function.
basically what I'm talking about. Yeah.
Yeah, so at the bottom of my charts, for anybody that's not aware, uh, there's this little indicator down here where my mouse is. This is an indicator called the percent daily range. It's one that Stu came up with, and it's just telling you the percent daily range, and I've got it set to the over the past 20 days. What's the percent daily range been over the past 20 days? So on this stock, as of Friday, the percent daily range has been 10.22 percent. Um,
Well, see, I probably get a similar number. I take the average true range divided by my entry number and get
mm,
whatever the move actually would be. It's probably how you calculate the percent daily range.
Mm.
It's similar, but not quite. What Chet's doing is a percent average true range. What Stu's doing is a percent daily range. They're very close.
Yeah, it seems like we're aiming to achieve the same goal.
The idea is you don't want to have a really big number because then you're all over the place
Well,
and it can go against you really quick.
I would offer a different point of view. I think that it depends on your style and your system. So when I see uh, a larger percent daily range and I see price tightening, like it was over here, this is this is a trade that I admittedly botched because I should still be in this, but I'm not. However, uh, when the percent daily range is on the higher side and the volatility is contracting like it did over here. So over here, the difference between my entry and my stop was 7.5%. And at the time, the percent daily range was 11%. That's something that's telling me that there's a strong chance that on day one of the breakout, I could hit a first scale out and potentially a second scale out. And that's with scale outs being at 5%, 10%. That's something
Yeah,
that I
and
like to see because it's getting me into it's getting me out of the open game, right? Like because once we get to the second scale out, that's one of the things that triggers an automatic like okay, you're out of the open, take your stop to break even, and then you're in the mid game to potentially getting to the end game right away.
it depends on what your system is. My system is long term and that much volatility shakes me out. So if you're a shorter term system and you want to get in exactly the right spot in your chart, you're going to make a lot of money with a more volatile stock. The same is true with your trading options. If you know how to set up the option position properly, the more volatility you have, the more money you can make. So you can look at it both ways. It depends on what your system is, though.
Right, exactly. Understanding your system is key. Any other thoughts, comments, or questions on this? Anthony, now that you're in the room, did you have anything that you wanted to add before we move on?
I don't think so.
All right, great. Anybody else?
Throw it. Maybe don't do that.
Anybody else have anything that you wanted to add?
Just to piggyback on what you're talking about, Chet's talking about volatility and looking at the percent average true range. And another parameter you could look at is historical volatility, and going for a lower historical volatility stock if you're looking to trade long term and you don't want to get shaken out.
All right.
I don't know if you were mentioning stochastics at all, but I've been noticing a interesting trend that it's pretty useful at predicting when price is going to pull in. if you look for divergences with that in price.
Divergences in the stochastic.
Yeah,
Yeah.
like I've been going over my trades, and it seems like when price gets to a certain level, like say it's up 10% or 15% or whatever, there's little subtle divergences sometimes that happen that usually a fall, decent decline follows.
Yeah, that's a great point too, and it's something that I've observed as well. It's something that I've observed in conjunction with other things too, and so uh, that was part of what prompted the development of the danger signals concept in the earlier part of the year. So. Well, what happened was I was looking at I wanted to see when should I be when I'm in a winner, when should I be looking to get out of a position that's starting to roll over and die right before the position implodes. Well, when should I exit, and how can I use uh, this to not dump a position that still has some room to run. So that was the concept of coming up with various danger signals. So that way, no one thing could knock me out of a position. And so I went back and I started to study all the different trades that I was in, and I started to notice that at the at the beginning of a trade, if I had 6 or more danger signals, then in practically every single case, that trade went on to hit the full stop and continue falling. So that was a very useful piece of information, because now when I see 6 danger signals at the beginning of the trade, I know I should just close it immediately. In the middle of the trade, when I had 7 or more, that's when trades started to deteriorate, but not always. So in those instances, it paid to raise the stop aggressively and then allow the market to either take out the stop or to keep running. So one of the things that constituted a danger signal was the stochastic rolling over. So I've got 2 things for stochastics over here. I'll make this a little bit bigger. I'm not sure if everybody could see it. So fast stochastic crosses below slow stochastic, and both the fast and the slow stochastic start to curve down. So what does that mean? So over here, the fast stochastic, the blue line, crossed the red. That's a danger signal. But right now, the fast is flat. The slow is starting to curve, so I wouldn't count that as a danger signal. It's just the 1, because the fast crossed below the slow. Over here, right, if we're looking at this section, this is where you have both the fast and the slow curve down, and the fast is below the slow. That the reason why that's important is because it's a sign of momentum out of the stock. And it's important to, or at least for me, I find it important because I don't know if this is going to be a consolidation or if price is going to continue falling at that point. So it's not a reason for me to exit the stock completely, but it is something that counts as a danger signal. And if too many danger signals add up, then you're tipping the scale, right? So you have your scale, right? You've got the scales of justice, right? You've got your scales of justice, and you're pouring on all these danger signals over here, and if they tip too much, then it's time to exit the trade. Sometimes you could get a couple of danger signals, and price action might look gnarly, and it turns out to not be that bad. And that's another thing that I found the danger signal concept to be useful for too, which is to add a bit more objectivity. Any other comments or questions or things to add? All right, if you have any other questions about adjusting scale outs to changing market environment, or questions specifically about the monthly tracker, or anything else that we've discussed at this point, feel free to post in the chat.